get started. So we're talking about tax planning for the 4 stages of retirement. My name is Chris Holcomb, financial planner with Heritage Financial Advisors. If we haven't met before, in Columbia, Maryland, we do 4 webinars a year. The next one will be on college planning in May. So looking forward to digging into this. So I want to thank you for coming, learning more about taxes and retirement. I want to assure you that the one thing about this presentation, that you'll be better informed about the challenges of retirement tax planning after listening to this talk. Now, you may be wondering, why is a financial professional giving a presentation about retirement taxes? Well, like I said, quarterly, I present webinars on various financial education topics, such as Social Security, retirement planning, IRA planning, healthcare planning, cybersecurity, that was last quarter's webinar, and late-stage college planning. My goal is to always inform and educate my audience so that you can understand how critical financial planning topics affect you and your family. I do this presentation because I've seen many people make mistakes and pay more in taxes than is necessary. When that happens, it makes my job harder because people have less income in retirement, and we have to find ways to make their portfolio last. Taxes can seem complex and jargon-filled, even though the underlying concepts are fairly straightforward. So let me take a second to explain how this workshop will unfold. This presentation is organized into 4 areas. Each key builds on the previous one, from a solution to our presentation problem, as you will see. I'm always trying to respect people's time, so I won't be taking questions during the presentation, as I said earlier, but I will try to take questions at the end if we have time. Again, otherwise, email us. Be glad to talk to you about your private situation, separately or with an appointment. Happy to do that and just see what we can do to help. I want to mention at the end of the presentation, I'll invite you to a tax and planning retirement overview. This is a private meeting that we offer to discuss private issues regarding tonight's presentation. Part of this meeting can be talking about your individual tax return. In this follow-up meeting I'm talking about, again, a slight fee may apply. So with that, let's go on to the first slide. Oh, let's go. There we go. Sorry. Okay, brain teaser. We'll start you off in the evening with some making you work. So what's going on here? Let's take a deep dive into this example. This is a brain teaser. Sounds like fun. So after working hard all his adult life, Bill has finally retired. He's going to more concerts than ever. Bill has $46,138 in taxable income, for which $37,500 is Social Security benefits. As you can see, Bill's $46,138 of taxable income puts him in the 22% bracket. Because it's more than $44,726 and less than $95,375. Towards the end of the year, Bill gets excited and he decides to take an extra $1,000 out of his IRA for a trip to see a Willie Nelson concert in Austin, Texas. How much will he be taxed for that extra $1,000? The logical answer is that every dollar of IRA money he pulls out, he pays 22 cents in federal taxes. Therefore, if he took out $1,000, he should owe $220 of federal tax. Sounds simple, right? He actually owes $407 in taxes because of the federal tax rate on that income. Thanks to the madness of our tax code and a unique formula that determines how our Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income, even though he only took a $1,000 distribution. Let's look at the different IRAs and how they're taxed. So traditional IRAs, you must pay taxes on the distribution or conversions as ordinary income, federal and state rates. Roth, money grows tax-free, earnings may be withdrawn tax-free in accordance with IRS rules. State taxes, we're not going to get into that in this presentation, but state taxes may still apply. Just consult with your local tax professional or your TurboTax. What I do is help people understand how the tax code and other rules could impact their financial planning and investments. And then we develop a plan to take into account many of the odd things people encounter, especially around taxes and retirement. Our goal here is to help you understand that retirement is a distribution game. Spending assets in retirement is much different than an accumulation game when you are saving for retirement. Chances are you've been in the accumulation phase most of your life for several decades, and now you've been working hard and trying to save money. Hopefully, the accounts have grown. But now as you enter and prepare for retirement, you're entering a different phase, a distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with these new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children are gone, and that means no more child tax credits. Your house may be paid off, and that means no more mortgage interest deduction. If you're already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you stop working, you may no longer have the ability to stash income in a 401k or similar plan to manage your tax bill. At some point, you'll start taking Social Security. And sooner or later, when you reach 73 or age 75, you have to start taking required distributions from your retirement accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they impact you is absolutely critical. Now, at this point, you may be thinking, okay, what's the first thing I need to understand about retirement and taxes? Well, here it is, the first key. You have to know what your after-tax retirement saving picture looks like before you actually retire. Because if you've saved $500,000 in a 401k or IRA balance, it isn't really $500,000. The government has claim on part of that money because the taxes were deferred. They get their share when you're forced to start your required minimum distributions. The RMD was 72 last year, but due to the Secure Act rule or law changes, 2.0, it's pushed back to 73 if you're born between 1951 and 1959. And if you're born after that, you won't have to start taking RMDs till age 75. Obviously, the higher tax rate in retirement, the less your account is actually worth. Here's an example. This chart shows the cumulative after-tax amounts you could expect to receive from a $500,000 IRA earning 6% a year at various tax rates. And as you can see, the lower the tax rate, the more you keep. Simple in theory, difficult to practice. And by the way, of course, this presentation applies to both pre-retirees and retirees. So don't worry if you've already started your retirement. Tax planning is important throughout retirement. Now you've been thinking, okay, my accounts may not be worth as much as I thought, but I've already have a steady flow of benefits from Social Security to supplement my income. And I have Medicare to pay my health care benefits. But one thing you need to understand when creating your tax strategy is Social Security and Medicare have their own tax traps, and you have to plan for them too. Let's go back to Bill from our brain tease. We want to understand why he paid such a high tax rate on the extra money when he took from an IRA to go to the concert road trip. Remember, Bill has $38,000 of IRA income. Part of his adjusted income of $61,838, and he has $37,500 of Social Security benefits. That puts him squarely in the 22% bracket, and he takes the standard deduction as opposed to itemized. Yet, when he took the extra $1,000 IRA distribution, he got hit with a nearly 41% marginal tax rate, $407 on that $1,000. Let's break it down and let's see what actually happens. First, remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from his IRA to go to that concert trip. You'll see that in the after concert trip column. He has $39,000 in IRA income. So Bill got hit with the Social Security tax torpedo. So let's see how he got there by adding $1,000 of actual income. It increased both his adjusted gross income and his taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed on $1.85. Wow. Here's the deal. Depending on how much other current income you have, the amount of your Social Security benefits are taxed varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he also must add an additional 85 cents of his taxable Social Security benefits. And if that adds up, that's $1.85, taxable at 22% rate for every dollar of additional IRA income he actually receives. If you do the math on that, it comes out to 40.7% real tax rate on an additional $1,000 of income. That so-called Social Security torpedo can impact single filers and married filers with even fairly modest income during the early stage retirement. It's one reason planning taxes in retirement is so important. All right, let's look at Medicare and taxes. Medicare has something called the IRMA. What is IRMA? It stands for Income Related Monthly Adjusted Amount. The emphasis is on income because it is a monthly tiered surcharge, again, a kind of tax that is tacked on to people's Medicare Parts B and D, but only happens when you have income over $97,000 for singles or $194,000 for a married couple. Let's look and see what that means. Meet Martha and George and Martha. They're high earning married couple, both on Medicare Part B and Part D. IRMA surcharges affect income for 2 years prior. Very important detail, very important. And this couple was on track for $306,000 modified adjusted gross income, or MAGI, in 2021. But on December 1st, 2021, George decided to sell the stock he bought for $10,000 on July 1st, 2007. He sold the stock for $11,000, resulting in a $1,000 gain. It was taxed the 15% long-term gains tax rate, plus an additional 3.8% for net investment income surcharge for the total tax bill of 18.8%. That 3.8% net investment income surcharge is another tax that comes into play when your modified adjusted gross income exceeds $200,000 for a single filer or $250,000 for a married couple. So George and Martha owe $188 of tax on the gain from the sale of their stock, right? Or 18.8% of $1,000. Or do they? Remember, my definition of the tax is that any cost that increases your income increases as your income increases. So that George and Marshall owe more than $188 because of the gain of the sale of the stock, push them off their Medicare IRMA cliff into paying higher Medicare premiums. Let's take a look. But that's not over, because Medicare Part D IRMA charges also are impacted. So Medicare D is prescription drugs. Medicare B is the, I missed one, I think. Yeah. So there's your Medicare B. They've jumped the bracket, and you can see that their charges went up. Now we go to Medicare Part D, which is the prescription meds. So George and Martha will each owe another $19 per month for their drug plans, an extra $460 for the couple over the course of the year. Adding all the IRMA surcharges together for the year, George and Martha will each owe about $118 a month, or $2,834.40. A big, big hit for that sale of that stock. So let's break it down a little bit more. Now, combine the amount with the $188 of actual federal income tax they would owe on the stock sale, and the total tax owed on the $1,000 gain comes to $3,022.40. That's a tax rate of 302%. Let me repeat that. That's a tax rate of 302%. So let's do a quick review. So they sold the stock for a $1,000 income gain, capital gain. The stock sale tax was $188, 15% for long-term gain, plus 3.8% for net investment income on high income earners. That's 18.8%. The extra income from the stock signals a new IRMA Medicare rate. The total IRMA surcharges amounts for the year to $2,834.40 for George and Martha. So the extra $1,000 income from capital gains triggers $322.40. That's 302% in real tax rate. You see, being pushed into the Medicare Part B and D premium range is worse than being pushed into a higher tax bracket. Because when you go into a higher tax bracket, when you go into a new Medicare bracket, even a single dollar, all you are in that rate for both of you. It's not like the tax code where only the dollars that go over that bracket are taxed at the higher number. So if you go over Medicare Part D and B and D income levels, even a single dollar, you'll move into that next premium tier. It doesn't matter if you exceed it by $1 or $10,000. That's what we call the IRMA cliff. Keep in mind, IRMA payments aren't determined by how much money you made the previous year, but rather 2 years. Again, very, very important. So it's your return filings so what you file in 2024, if you are taking Social Security, will impact your rates in 2026. So just another way of saying it. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll Medicare at the right time is also a critical decision. If you bungle it, you end up getting hit with a lifelong penalty. To help you understand, meet Jim and Ann. Both 68, Jim retired at 65 and retired at 66. Prior to their retirement, the couple had health insurance through Ann's employer. And they continued that after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize their mistake until it was too late. And thanks to the way Medicare enrollment period works, they weren't able to begin coverage till the next year. In a worst case scenario, this might have resulted in a gap coverage for Jim and Ann if they had a major medical need. But even in the best case scenario, Jim and Ann missed their deadline to sign up for Medicare Part B. They will each owe an additional 10% for Medicare Part B base premium penalty for life, 10% for life. You can see how that translates in real dollars. They owe $395 extra in 2023, and historically, we can estimate that premium will be higher, so that 10% penalty will grow and grow. Over the course of time, it could translate into a $10,000 mistake for that couple. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know there would be a penalty for that too. So now we've seen Social Security, Medicare, their own tax traps, unique rules and penalties. So if you're like someone who has never seen this presentation, you may be asking yourself, wow, there are so many tax traps we will face in retirement. Well, the rest of what we'll cover will seem like Social Security and tax torpedo and the IRMA cliff. The public generally isn't aware of those squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. That brings us to our third key. You must plan now and when to use your taxable, deferred, and tax-free assets to manage your income and tax-free brackets efficiently. So with our clients, we try to get them all set up with both a pre-tax or taxable, tax deferred, that would be IRA, Taxable will be a brokerage account, individual account, joint account, all trust account. Those would all be taxable. Tax deferred would be IRAs. Tax free would be Roth IRAs or HSA accounts. So our goal is that each client has a healthy balance in each of those so that when you're retired, you're not earning an income to cover those extra taxes. You can pull your withdrawals from the account that's going to give you the best tax break, or a combination of those accounts. That's probably most likely what will happen, so that you can adjust and still get money to pay your bills, but also get it more tax efficiently. You cannot be haphazard about tapping into your deferred savings. Timing is everything. If you don't plan carefully through stages of retirement, you'll encounter unintended tax consequences. So let's first address the question I often hear in retirement: which accounts do I spend first? One way to help manage your income both before and during retirement is to utilize a Roth conversion. We are huge fans of Roth conversions. I talk to my clients about this all the time. A Roth conversion is a simple process that allows you to move money from an IRA or a pre-tax retirement account like a 401k to a Roth IRA. In general, the amount that's converted is added into your income for the year and will be taxed at your tax rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she'll have to add $100,000 to income. The conversion income would be taxed at Jill's rate. So one idea that we do suggest to clients is to offset your taxes from a Roth conversion with charitable contributions. So if you already have a charitable plan, using a donor advised fund is a great way to mitigate or minimize those taxes. If you're more interested in a donor advised fund and how that works, please let Carrie know when she reaches out to you via phone and or email. A conversion doesn't need to be all or nothing. So many times when we do conversions for clients, we talk about, how much can they pay the taxes on? Let's convert as much as you feel comfortable with paying the taxes on. It doesn't have to be the whole count. One helpful approach is called filling up the bracket. Often you may find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into the higher tax bracket. For example, in 2023, the 22% bracket for married couples filing jointly goes from about $89,451 to about $190,750. If you file a joint return and your taxable income is $100,000, that means you could add another $90,000 of income without going into the next bracket. Making a Roth conversion like that could make sense. If you plan to convert a large IRA, this approach is often more efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years. One of the best times to do that is when you retire. You switch from your high income brackets, essentially probably 2 spouses working, to a much smaller bracket. And so that's one of the times we like to look at that. You want to fill up the bracket each time. It can reduce your average tax rate that you pay for your converted money, and also spreads tax over a long period of time. Some tactics you could use in managing income taxes around brackets might include withdrawing tax-free money from a life insurance policy to keep income low. So that would only be a cash value life insurance policy, obviously. Selling highly appreciated stocks for low or no capital gains. Another strategy would take those same stocks and donate them to a donor advised fund. No taxes to you and no taxes to the charity, obviously. Taking distributions from an IRA or 401k to take advantage of a lower tax rate. Again, most likely that is when you first retire, those few years before you start taking Social Security, if you've chosen to wait, as we would recommend. As you can see, you can also consider partial conversions to fill up that lower tax bracket. Two other pre-retirement strategies there's to consider, but they don't apply to all people. First thing you have to do is look at a healthcare savings account. That would only apply to people who are covered by a high deductible healthcare plan, and you want to be fairly healthy because the deductibles are, as stated, much higher. The second has to do with small business owners, those who want to be extra tax savvy in retirement, for the retirement fund company pension plan, for which high earning business owners can decrease their ability to claim a qualified business income deduction. I don't think anyone on this webinar is a business, but I'm not 100% sure. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax favored benefits throughout retirement. If either or both of these apply to you, go ahead and note that, and we can discuss that later. Charitable giving, we touched on this on the previous slide. We've seen throughout our presentation the critical importance of managing your tax deferred accounts, because at some point you'll be forced to take out required minimum distribution. So we said that's going to be 73 or age 75. And that can be troublesome to your tax bill. But many people make charitable donations supporting their favorite nonprofit with annual gifts. So let's look at how your required minimum distributions and charitable giving may work for you with some planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now the standard deduction for married couple filing joint in 2023 is $27,700. But Albert and Shirley are over 65. So these get an additional standard deduction, bringing their total standard deduction for 2023 to roughly $30,700. This means that we'll receive no tax benefit for an itemized deduction unless their total exceeds that of $30,700. So if Albert and Shirley have $15,000 in existing itemized donations, say from state and local taxes, deductible medical expenses, mortgage interest, what happens tax-wise if they donate $5,000 to charity? They get no federal tax benefit from making the charitable contribution because it doesn't exceed their standard deduction of $30,700. That isn't to say they shouldn't donate. Just understand that it's not going to save on your taxes. So if you're over 70 and a half and you have an IRA or an inherited IRA, very important, because that comes into play here as well. There's another way to give to charity than simply writing a check. It's called a qualified charitable distribution, or QCD for short. Let me explain to you how that works so you can see how it's so powerful. First, some rules. If you're 70 and a half or older, you can make qualified charitable contributions of up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or older, and both of you have an IRA, you can each make up to $100,000 of qualified charitable contributions from your IRA. The second, any qualified charitable distribution you make counts towards satisfying your required minimum distribution for the year. So very important that if you want to make a QCD contribution, it has to be first. All right. So don't take your required minimum distribution and then think you're going to do a QCD. You have to do it first. So the first money comes out counts as your RMD. Very, very important. However, when you make the distribution from your IRA, it must go directly from your IRA to qualified charity, or they can receive a check from your IRA custodian made payable to the charity. Either way, it has to go directly from your custodian. In our case, that's Fidelity, to the charity. Third, this is an odd part. Even though you gave to the charity, you get no income tax deduction. So why would I suggest this strategy? Well, you get no deduction for giving it to the charity. Because when you make the qualified charitable distribution, the distribution from the IRA is never counted as income, which is a very good positive when you compute your taxes. So you don't get the income. Obviously, the charity doesn't pay taxes. But if you have giving goals or giving plans, you can certainly use the QCD to make that part of the giving plan or giving goal. So let's suppose Albert and Shirley do what many retirees do. Albert takes his required minimum distribution of $5,000 at the beginning of the year and deposits in the bank. He's done with his RMD for this year. Now, being a charitable people, they donate $5,000 to charity. The end result is that the charity gets $5,000. Everybody understands that, right? But let's look more closely. By virtue of giving to the charity this way, Albert and Shirley's $5,000 charitable contribution will cost them $6,200. Why? Because the $5,000 RMD that went to Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket, and 24% of $5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is not $5,000, but $6,200. Remember, the gift didn't impact their standard deduction. The RMD behind the gift just added to their income. Ouch. Okay, option 2. Let's see what happens if Albert and Shirley used their QCD to get the $5,000 of charity. Instead of requesting a $5,000 distribution from his IRA to go to his bank account, Albert would simply have his IRA custodian transfer the $5,000 directly from his IRA to the charity. This satisfies Albert's yearly RMD because he's over 73. So, important distinction here. You can give a QCD at 70 and a half, but your RMD doesn't come into play till 73 or 75, depending on your age. Okay, so that's just an important distinction. Now, the charity is in the same position as before. They receive a $5,000 donation a good day. Albert and Shirley, however, are in a better position. They still gave $5,000 to the charity, even though they didn't receive a deduction for making the contribution. Their IRA distribution is included from their tax return. Very, very helpful. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to get the $5,000 to charity is $5,000 minus $1,200 savings over the previous example. Simply by knowing how to use the tax rules to their advantage, and they did that without even getting a deduction. But we all know charity starts at home. So the natural question is, how does retirement planning figure in? It's a very good question because the government still wants its share of those tax deferred assets when you pass away. So now let's look at something that really matters, which leads us to our final key, number 4. Organize your assets for your family's benefit. Estate planning. Let's talk about long-term care. This isn't a long-term care presentation. It's about retirement taxes, but I believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be deductible medical expenses at the federal level and possibly eligible for deductions and credits at the state level. And on the other side, if you're receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received from reimbursement style policies are tax-free. Choosing how to pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. So there's basically 3 ways to pay for long-term care. Traditional pay-as-you-go long-term care, which is very similar to homeowners insurance and car insurance. That is, you pay for that protection, but there's no residual benefit if you don't use it. Then there's a hybrid policy, which is what we're going to talk about here. It's a policy that combines life insurance and long-term care. And then the third way to pay for long-term care is a asset-based long-term care. So, for example, you put down $50,000 to $100,000, buy a policy, and you're done. You never have to make a premium payment again. Excuse me. What we're talking about here is the hybrid policy. Often the first inclination of the insurer is to tap in their policy to pay for long-term care benefits, but that's often a tax mistake. Let's look at Florence, a widowed woman who qualifies for long-term care benefits and lives at home with in-home care. Her yearly costs are $60,000. Florence's Social Security is $20,000 a year, which covers basic expenses but not long-term care. She also has a $400,000 in an IRA and a life insurance policy with long-term care rider that will pay $500,000 to Florence's children upon her death. Alternately, Florence could use up to $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Please note this is just an example. It's not to represent any specific policy, but many long-term care life insurance hybrid policies work this way. First, suppose Florence is infirm for 5 years and uses her policy to pay for long-term care expenses. That's what she bought it for, right? Here, Florence pays little or no income tax during this period because she'll have such large unreimbursed medical deductions. The $500,000 policy pays out $300,000, $60,000 per year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children receive $400,000 in her IRA, which will be taxable to them. That's very important detail. IRA proceeds are taxable to whoever inherits them, whereas life insurance is transferred tax-free. So we're going to see that. Now let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for long-term care expenses instead. Florence still pays minimum taxes per year because of a high medical expense deduction. And now the kids will inherit $500,000 of life insurance completely tax-free, as well as roughly $100,000 of remaining IRA money, which will be taxable. So we went in the first example from $500,000 of taxable IRA to the beneficiaries to $100,000 by using the paying for the long-term care differently. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying for the long-term care with Florence's taxable IRA money. Okay, we're towards the end of our presentation. Goodness, how in the world are we ever going to manage it? It's a good question. Let's bring it all together. So we started with a clear statement about the problem. Retirees often pay more taxes than expected because of the confusing system treats various income types differently and contains hidden taxes and penalties. Let's do a quick review on what we've learned in the text of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding after-tax value of your retirement savings before you retire. We're huge fans of Roth IRAs. We're huge fans of Roth conversions. This is when we do that, pre-retirement and early retirement. We also saw in those pre-retirement years, it is critical to consider your tax-deferred savings and start taking advantage of Roth accounts to fill those brackets. Something you'll do through your retirement early years as well, low tax years. We also looked at Social Security and taxes, plus the importance of couples who have benefit strategies that consider the surviving spouse. We also saw that Medicare has its own tax structure that can push you off the IRMA cliff, and we saw the importance of signing up for Medicare on time, right in the middle of those go-go years. Because your tax exposure will change throughout retirement, you need that. Anticipate how and when to tap in your assets, your personal savings. Understand the range of taxes that you'll face in various stages. Manage your actions so you'll pay the lowest tax rate possible. By attending this presentation, you're indicating that you'll be better prepared to leave the accumulation phase, saving for retirement, and moving into the distribution phase when you start spending the retirement assets. We've seen the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning, and we've seen the cost of mistakes. Naturally, we want to be very efficient with our savings and these strategies to reduce our tax burden. But there's many other things in life that takes education and planning. It's a lot to think about. Our tax code is complex, and the rules keep changing. But what doesn't change is your need for a plan. So like I said before, we're happy to talk about taxes and retirement. We're happy to set up a meeting, a call. Certainly when Carrie reaches out to you to solicit your feedback and questions, you can set that up with her or feed her your questions, but we very much be glad to do that. Regardless of when you informed about your retirement planning needs and what to consider doing next, we want to be prepared and organized for this aspect of your life so that you and your family have peace of mind, knowing how to get a plan and making the most of your retirement accounts. A lot of material there. I apologize, I'm recovering from a sinus infection, so my voice is a little raspy, but hopefully we still communicated concepts well. Please call me. It's a lot. It was probably difficult to follow some of those items, but we're here to help. Whether you're a client or not, we're here to help. We'd love to meet you if we haven't met you before, and certainly happy to chat through your questions. So it doesn't look like we got anything in the queue. I want to thank you guys for joining us. I hope you found it really helpful. And again, we're here to help. Please respond to Carrie's email or phone call so we can make sure we get some good feedback and questions answered for you. Have a great evening. Take care.